This is Behind Closed Deals.
We'll be chatting with multifamily maestros,
Uncovering their strategies,
and unraveling the latest market happenings.
bringing you intel you can't buy.
All right. Well, thank you for joining, Ken. This is our next episode of our podcast, Behind Closed Deals. We've got Kent Ritter here as our guest. So, Kent, it would be great if you could give us a little bit of history of Hudson Investing, deals that you're looking at, and how you got to today.
Yeah, Cam. Sure. Yeah. Thanks for having me on. This is fun to come be on the show and get to talk about some of the things we're working on. So Hudson Investing, I guess to start, I'm the CEO of Hudson Investing. Hudson Investing was founded in 2019. And really what we do at Hudson is we buy and improve, or we build from the ground up multifamily properties throughout the Midwest and the Southeast. And we bring investors into those deals and be able to get some great returns back to our friends and family in doing that.
I love it. So what we thought would be fun is if you could talk a little bit about how you got into multifamily, maybe even go through your first deal that you did.
Sure. So there's a couple of steps for me getting into multifamily. So what really kicked it off was I had a previous life. I was in management consulting, had a management consulting business in Chicago, sold that business in 2015 and had a big capital event, also had a big tax burden. And talking to my CPA and said, wow, how do I avoid this in the future? It really came down to, I didn't have any assets outside of our own house. And so as I was looking at how to deploy that capital, I didn't want to double down on the stock market and the up and downs of equity. I already, was invested there, as most people are. So I was really looking for an alternative. And as I checked into a lot of different things, real estate checked all the boxes for me, also checked the boxes for my CPA. And so really got into real estate because of that. But I started, as most people do, with like what they know, what's familiar, what's around them. And what was familiar around me was I had a family friend who owned some single family homes. And then I had another family friend who was buying notes and would do land contracts for single family homes to kind of be the bank. So I really started out in those strategies in single family. But what I learned quickly through education, paying for courses, paying for mentors, finding some other mentors, was just that there's no scale there. And that was something I learned as a manager consultant in working with a lot of businesses is there's power in scale, right? So anything I was looking to do, I was looking to create economies of scale and scale up. That's what I learned about multifamily and the ability to go out and buy, let's say 100 units under one roof in one transaction versus having to go out and find 100 houses, right? And so that's what really attracted me to multifamily. I was attracted to multifamily versus other asset classes because, and this has really been proven out now, like we've proven that you don't need a place to work, but you absolutely need a place to live. And when you look at the supply and demand in this country, there is a massive difference between the amount of supply we have and the amount of demand we have. And whatever study you look at, we're somewhere around 4 million houses short for people to live. And so being an econ guy, it really just made a ton of sense to me, multifamily. And it started out, so when you talk about like the different levels, I started out as a passive investor. So I started out investing in other people's deals when I was still running the business we had now sold. I was just deploying capital, right? And when I got into these deals and started really understanding the mechanics, I was really looking for what that next adventure was going to be for me. I just fell in love with real estate as I continued to educate myself from like 2015 to 2019, which is education, investing with other people, learning. 2019 felt like I really had it down and went out, founded Hudson Investing. And it took a while to find that first property. But, COVID hit, all these things happened, right? But the first property that we acquired was in 2021. So it took a little bit of time, found a great asset, I had done a few other properties in different joint ventures and partnerships, but the first Hudson Investing asset was really a property on the west side of Indy. We bought for about 1.3 million. It was 29 units. It used to be a roadside motel, kind of a little hidden gem. And I saw the potential of being able to buy it directly from the buyer. It was off market. We were able to enter at about 36,000 a door. Literally it had a gravel parking lot. Like, it needed a lot of work. So we bought it for 1.3. We put 600,000 into it, which included building out 4 additional units and just some empty space. So we turned it into a 33 unit. And it's just been a fantastic deal. We've been able to pay current all of our returns. And, I think valuation now is probably somewhere about 100,000 a unit, based on where we've been able to take income. So just a fantastic, kind of first project. I think a lot of it being around just being able to be in at such a great basis, locking in good fixed rate debt, which are things I'd recommend if anybody getting started, is taking that interest rate risk off the table. But yeah, it's been a great story and case study for us, that first asset. Now it's kind of crazy. So we bought that one for 1.3. The last deal we just closed was a $22.7 million property, which is a BTR deal we just purchased. So we've really scaled up, I think responsibly and mindfully in those 5 years, but we're just in a totally different place now, which is very exciting.
Yeah, that's super interesting. So if you started Hudson in 2019, that was a fun time to get into real estate. It was right when the market was starting to go up really quickly. Yeah. Did you have to submit offers on a lot of deals between 2019 and that first deal in 21?
A lot of deals. Yeah. And it took a long time because in that time in the market, prices were just going up and up and up. And as I was underwriting, I wasn't winning those deals. I wasn't winning those best and final rounds, right? And so I came in second place a lot. Fortunately, I had some other income streams. I was able to kind of just hold to my guns, and I'm happy I did that now, but it was definitely frustrating at that time. And then we kind of went into COVID, and it was kind of like, what are we going to do? And so what I did in that time was I took a little foray and actually went to work for one of my mentors because I thought, well, we're having a hard time doing this. I had an opportunity for one of my mentors offered to let me come in and work in their shop on the acquisition side. And it's a large PE firm in town here in Indy. And so it really was a great opportunity kind of through 2020 and into the beginning of 2021 I call it like my real estate MBA, right? Get some great experience, see how the big boys really do it. Came out with some fantastic knowledge. I think I definitely added value there, but I took value too. And, but when I looked at coming through on the other end on 2021, I really said, if I'm going to do this, I really want to do it on my own. I'm just an entrepreneur at heart. And, so really as we kind of relaunched in 21, that was where we really hit the ground running through that. So it was a great little segue or great little transition, able to create some knowledge and be able to come out better even on the other side.
Right. Yeah. Buying a $1 million or $2 million deal in 21 to buying a $22 million deal today is a big difference in the equity checks, right? So that's very impressive. So how did you learn and how did you build out your network so quickly, I guess, to be able to do it?
Yeah, it's a really good question. I think it's what a lot of people are struggling with right now is how do you really attract investors? One of the best things that I did was in 2020 as really a COVID project, I started a podcast. And it's called Ritter on Real Estate. I still do it today. And that was an amazing way to reach out to people and help people understand who I am, what I'm about, get to know me, hopefully start to like me, start to get some trust that I really do know what I'm talking about. So that was a great way to attract investors. And so people will listen to the podcast and then they'll they'll come to the website and they will say, yeah, I'd love to learn more, and they'll set up a call. And so that's one of the best ways that we scaled our investor base. But also the other side of that is I just get to network with hundreds of amazing real estate people that are all successful in the space. And so it's been great from a networking opportunity too. It's created partnerships and different things that we've done. So that I would recommend, if anybody wants to raise capital or just get in front of investors, you got to figure out a way to really get out there. Podcast, just like you're doing, Cam, is a great way to do that.
Yeah. And so equity raising today is a lot tougher, like you said, than it was a couple of years ago as brokers. And our best and final rounds, we're really digging in on our questionnaires as to where the money's actually coming from. What's your most recent equity raise, to really understand if the buyer is capable of getting the deal done. So what are the differences that you're hearing from your investors today versus a couple of years ago?
For sure. Well, it's just a totally different perspective, right? If you think about people's perspective, 21 coming into 2022, I mean, real estate had done nothing but go up really in all asset classes since like 2010, right? So there's just this tremendous run of cheap debt, a massive appreciation. And so people were just giving money without really asking, I think, enough questions. And, I think as we moved as interest rates started to rise and as we started to see inflation come up, I mean, what we saw was people really, start to think more about their investments. As inflation rose, as interest rates really rose, we saw asset prices in real estate in 2023 really for the first time take a step back in this long run. Like usually real estate cycles are about 8 years. This was just a longer cycle. But a lot of those people that came into deals from 2017, I would say like in 2017 was when people really started getting as passive investors, these like private real estate deals on their radar, and that really increased. And so people had never seen anything but up and up and up. And also all bad operations were just glossed over by cap rate compression and increased values.
That's right.
Right. And so when I talk to investors, a couple of things that we have to overcome from people that are just meeting us and coming from other places is that a lot of their projects, they've paused distributions, right? Or things haven't gone well, and the cracks in operations have become craters. And so it's just, helping people understand that, just because they've had a bad experience over here, how we do things differently and how we think about things differently, right? That's one thing, but just trying to kind of combat that. I think two, people are comparing their investment opportunities to putting their money in a savings account and making 5%, right?
Right.
And so our investment opportunities still have to remain attractive in an environment like that. I think if you dig a level deeper, you understand that 5%, if you're in a 40% tax bracket, is really 3%. And that really starts to erode your earnings. But we have to just educate folks. So it really is all about education. It's leading with education, helping people understand the environment, and helping people understand really my perspective, which is this is a fantastic buying opportunity. And I've had this thesis for a couple of years, right? Through 2023 and 2024, we've been talking about we want to be buyers right now, net buyers. And we want to be because we're a smaller firm, we're more agile. We can still find great deals. We don't have to take down these monster properties because of our overhead. We can find these gems. And we want to be net sellers in like 26 and 27 when a lot of these bigger firms are starting to re-enter the market. And when interest rates have started to come down, because they will. They can't run at this level forever. And every day forward is a day closer to when rates start to come down. And we've seen some great data points about this, right? We've seen some of the massive groups, Blackstone, but everybody's talking about their $10 billion investment in multifamily coming back in. KKR just announced a $2 billion investment in multifamily. It's in Howard Marks from Oaktree, one of the probably most famous investors out there, talking about how commercial real estate in general and multifamily and industrial is kind of the two highlights as like a once in a generation opportunity to buy assets at distressed prices right now. And so it's one of those of trying to educate investors that right now is a great buying opportunity because prices have stepped back and you're able to get in at a great value. And you can even think about it as like dollar cost averaging on your stocks of like, you continue to invest, you're going to buy some at higher prices, some at lower prices, but as you buy it lower, it's going to bring your average down, and you continue to invest, you continue to diversify, and you continue to roll that forward. But right now, really, in my mind, is a good buying opportunity as we move from 24, up until we get into 25, and we'll have to reevaluate.
Right. Right. You mentioned this a little bit, but you actually just closed a deal up in Whitestown with D.R. Horton, which is a huge feather in your cap, really. I think, one, BTR, unique product type that's coming out today, but also to buy from one of the largest home builders across the country is pretty cool. Could you talk a little bit about why you did the deal, why you're excited about BTR, and then also how it was during getting that transaction done?
For sure. This property I'm extremely excited about. It really is. It's following the thesis of those groups I just talked about. If you look at like what Blackstone and KKR bought, it's newer, nicer properties, right? And that's exactly what this deal was. But to start with the market, as I always do, if you look at where it's located in Indianapolis, which is Whitestown, which is kind of that northwest corridor along I-65, to me, that is the kind of last growth frontier on the north side. We're seeing Lilly with their $9 billion investment coming in the Leap District up in Lebanon, just north of the property. It's going to create thousands of jobs as that whole area comes online. So to me, it always starts with the market and the growth that's coming there. And this is where growth is happening, right? We're still, I think, ahead of the curve a little bit on that growth frontier where we're at. And then when you look at the asset class, it's right now where I'm seeing opportunities is not so much in the workforce side of things, because we're seeing Class A assets with price compression that when you look at it on a cap rate, it's a similar cap rate as I could go buy a Class C property. And so I'm going to buy that newer, nicer asset every time. And when you think about it from BTR, the built to rent, why that's so important is because these are townhouses with 2-car attached garages. You have your own yard, you have your own driveway. When you think about the housing affordability, right, it is further away than it's ever been. The average house in that area, entry-level house, is $400,000. The mortgage on that is going to be like $3,200 a year. So when you think about our rents at about $2,300, they're relatively affordable, and it's as close as you can get to owning your own home without owning your own home, right? But it gives you that quaint neighborhood feel, your own garage, you've got 2 stories. And so for all those reasons, I just thought that this was going to be a home run play. And we created a great relationship with D.R. Horton. They were a fantastic seller. And I think we were able to, I think the reason we won the deal was less about price, because I think there were people up in the stratosphere. I think it was more about understanding their business plan and their needs and being able to meet those needs. And one of those was being willing to take on the lease-up risk for that property. And we were willing to do that because we had other properties in the market, and we knew the strength of the market, and we knew that we could lease it up very quickly. And that's played out.
So do you plan on operating your property up there differently than you have your conventional properties, or is BTR, you're just seeing it as a typical apartment community?
It really, we don't need to overcomplicate things. It really is an apartment community. They're just laid out horizontally in a neighborhood, right? But we're going to manage it the same way, right? Professional management. There's going to be, you have full-time maintenance. We've got somebody taking care of the grounds. You really, a lot of the dynamics are similar. I think where dynamics really differ more is in that Class A versus the B or C expectation. I think there's just people that are going to pay $2,300 to $2,500 a month in rent. You've got to make sure that they're having that level of experience, right? You're taking care of them. You're showing up professionally. And I think, to me, that's probably one of the different ways, is just the management, the type of management, the amount of touches, with residents that you're going to experience. More than the difference of, running a 50 unit versus these townhomes.
Right. Right. I think it's the right way to do it. I've thought that BTR, there have been groups that have come out and said that it's going to be, residents will be responsible for certain maintenance requests or mowing their grass. And I think the only reason why it's gotten away with it up to this point is there's not as much competition. Mm-hmm. So that they're comparing to a one-off single-family rental where you do have to do those things.
Right.
But having it professionally managed, and as there's more competition, you will have to do that. If you built an apartment community today and said, we're not going to fix anything and we need you to go out and mow the grass, you're like, what am I paying for? Right?
That's right. That's right. And when I look at it compared to the competition, right, because there are some great Class A traditional multifamily properties in that area. But where I think we stand out is the neighborhood feel. It's the attached garage. It's the 2 stories. Like for anybody that has kids, just knowing that separation, keep toys around, is great. And I think you have to try to keep the amenities similar, so you're removing that comparison point. Because if somebody's like, oh, I got to buy a lawnmower and I got to mow my own grass, then I think that's a different decision than just be able to move in and know that you've got everything taken care of. And a lot of people that are coming in are people from out of state as well. People that are relocating for work is a lot of what we're seeing. And so, a lot of those people don't want to have to come in, buy a new lawnmower, worry about all this. They just want to move in, be ready to go. And, we're trying to take away as much as they'd have to worry about as possible.
That's right. That's right. Another unique deal that you guys did, that you bought a property in Fortville. You're going to build another phase, and I know you're looking at another deal that's very similar as well right now. What made you get into development? A lot of people that buy properties are like, I only buy properties. I don't know anything about development, and you guys have really stepped in and done well.
Yeah. I mean, man, development is a different animal. It is a completely different skill set. And so I think a lot of people look at that and say, wow, that's hard. There's a lot of risk. I think it's a willingness. And I've always just been willing to just dig in and figure it out. And I love to learn. And so to me, as I want to be the most rounded real estate investor possible, I never felt there's a way to do that without knowing how to develop from the ground up. And honestly, everything I've learned about construction and the entitlement process, and even going out and working with the municipality on financing, has made me a better investor on the acquisition side too. And so they just definitely complement each other. But I also think, when I think about it from a business perspective, I think you want some diversification. You don't want, I mean, Cam, look what's happened to deal flow in 23 and 24, right? I mean, you know the numbers more than me, but it's down significantly. So right. A lot of groups that can only acquire have been sitting on their hands. And when I think about my employees, and everything that we produce, like our ability to develop, and especially this project in Fortville that we're working on right now, has brought in income. It's a diversified income source. We were able to get that project launched when we weren't acquiring at the clip that we wanted to. And so I just think it allows us to have a more diversified revenue structure, from different sources. And these things ebb and flow, right? I mean, a couple of years ago, if you told me I was going to be developing projects and have multiple developments going on at the same time, I'd have said you were crazy. But I'm also nimble enough to move with the time and see where the market's going. And developing right now is a fantastic opportunity, because what has happened is, with interest rates so high, most development projects have stopped. I mean, we're not seeing starts. We saw a girth of supply in 23 and 24, but when you look at 25 and 26, there's hardly any supply being delivered. You really can't get projects to pencil right now unless you're creating a public-private partnership where you're getting some incentives from states, counties, the municipalities to help clear that gap. Because when you go out and get a construction loan, you're going to get 65% of your value, and you're going to have a huge equity slug. And honestly, just without something to help, those returns are not attractive to investors. I wouldn't do that on just a risk-adjusted basis.
Right.
Because you're picking up extra risk because the property's not cash flowing, right? You got to build it to make it cash flow.
Right.
And so
That's right.
with that extra risk, investors should expect extra return. And so I think if you can't bring this kind of creative financing in, you can't get that. That's why a lot of these projects aren't getting off the ground. And so it's a fantastic time if you can get a project off the ground. I think you're going to be delivering into a really attractive market in 25 and 26 when you really start to see rents move up because the demand isn't slowing down, but the supply absolutely is.
Yeah. And you guys have bought properties outside of Indiana and Indianapolis, right?
Yeah, that's right.
So,
We have properties in Kentucky, Ohio, and South Carolina as well.
And so what was it like the first time buying a property outside of your backyard? Was it scary? Was it, how did you plan to get it done? What was it like?
Yeah, I mean, it all starts by being market driven.
Mhm.
So every year we do a markets of interest analysis where we have a big spreadsheet. We throw a lot of data into it, census, CoStar, purchased information, and we have all these key metrics and we weight them in a matter of importance. And it really ends up with like an index score for us where we can rate these markets from 1 to 100. So we really start there and say, okay, these are the top 15 markets that we want to be in. And then we go out and we find partners in those markets. Number one being a property manager. So I think before you enter, if you enter a market by finding a property and you say, oh man, now I got to find somebody to manage it, you're behind the 8 ball. You got to find the manager first and you got to leverage their boots on the ground to help you find the right properties because they're going to know the submarkets, the streets, the neighborhoods better than almost anybody. And also we've done it through partnerships on the general partner side as well. So that's how we enter new markets, is not being in by ourselves because there's so much expertise that you don't have if you're not local there. So that's how we've entered markets, is really through partnerships. And it's been a great model, and it's allowed us to, I think, just not make some mistakes that others could make if you're doing it that way. So, it's always, it's definitely not scary because the data is driving us and the good partnerships are helping us succeed. And really, if you're in a market that's very high growth, which is why we enter other markets, it's either high growth or there's no supply and there's just a great dynamic there. That would be like a Cincinnati. Versus very high growth would be like a Spartanburg, South Carolina, where we have properties in both. If the rising tide is raising all ships, it helps. And I think you have to have that dynamic as you enter any market.
Yeah. Yeah. And that makes sense. Do you guys have plans down the road of bringing management in-house and doing construction in-house? I know a lot of other groups have done that over time. Is that a goal for you?
It's definitely something that we talk about, but I think as we talked a lot about scale, to do those things, you have to have the right scale. I think right now we're focused on just being the best at finding great assets on the acquisition side, developing great assets and managing that construction process, and then asset managing at a higher level. Really digging into trends and numbers and managing those property managers. And so those are really our core competencies and the core focus of our team. I think as we grow, we'll definitely look at opportunities to vertically integrate, but there's trade-offs to doing that. One of them is you can't fire yourself. And so you gotta be, if you're going to get into it, you got to be really good at doing it, and you have to have the scale to be really good at it. And so, right now we're about 900 units. I don't think we're quite there yet. But as we grow, and as I look at the strategic plan, all of those opportunities, I think are out there at the right time.
Yeah, that makes sense. That's exciting. So, well, thank you so much for joining our podcast. We're excited to have you on. We're excited we're doing a deal together right now. We're excited about that. So
Absolutely. Long time coming, Cam, and appreciate you and all all the efforts you've gone through that process. And yeah, I appreciate you having me on the show. And yeah, looking forward to just everything that's going on now and the future.
Yeah. Well, thank you guys for joining. This is our next episode of Behind Closed Deals. And as George always says, you're only as good as your next deal. But thank you guys.
Thanks for tuning in. Stay in the loop by hitting that subscribe button and check the show notes for additional resources.